welcome back, everyone. I see all the numbers starting to pop back in from our Peter Schiff opening speaker. He was fantastic. I hope everyone enjoyed hearing what he thought really where North America is going with our dollar, which gives you all the more reason to listen to Trey, who's going to be speaking just a moment here about his company and finding a possible exposure to gold and how to really take advantage of precious metals during these times. So I am going to be handing it over to Trey. We're going to be he's going to go over his presentation in detail. And then afterwards and throughout this presentation, we really encourage you. There's a chat function here. Please, there's a lot of like-minded people who chose to take this morning or afternoon, wherever you are, to really put time into their portfolio, put time into investments, and learn more about it. So you're with like-minded investors. We'd love to see you speak with one another. But also, if you look over, there's a Q&A function. In that Q&A, if you put your questions there, what the second half of this presentation, of this webinar, is going to be Trey answering your questions. So if you have questions of any kind, we'd love to hear them, and Trey would love to answer them. So without further ado, Trey, I'll hand it over to you, and I'll come back on when you're ready to go into the question period. So good luck on everything with yourself.
Great. Thanks, Brandon. And thanks, everybody, for tuning in today. Thanks to the Follow the Money Group and IR Inc. for putting this virtual conference together. And I'm going to jump right into the presentation and skip quickly over the the forward-looking statements because we're sure to make some of those. And just talk in general about the overview of why to invest in Ely Gold Royalties. And before that, just to say why invest in royalty companies. If you're looking for leveraged exposure to the gold market, royalty business is an excellent way to get that. Of course, on the equity side, you get the leverage with the royalties. You get the exposure to those actual mined assets without the exposure to the increase in production costs. You get the benefit of expanded resources through exploration without the exploration costs. And it's just an excellent low overhead business where, in essence, if you own a royalty, a net smelter royalty on a gold property, producing gold, what you own is actually a percentage of the gold and a percentage of the revenues when that gold is mined and sold. So with Ely Gold, we are Nevada focused. We've got a large focus there with a background that goes back for 35 years for my partner Jerry Bachman and one of our directors, Bill Sheriff, of prospecting and just really knowing the lay of the land and where the good properties are. And we tend to pick up a lot of those properties. Jerry actually goes out and stakes those the old-fashioned way. So because we're Nevada focused, we are gold focused. While it's called the Silver State, not a lot of silver comes out of Nevada these days. It's mostly all gold. And just to give you an idea for people who haven't heard my presentation before and some of my quips and quotes, if Nevada were a country, it would be the fourth largest gold producing country in the world. That's how much gold still comes out of Nevada. Ely Gold Royalties has been a great performer. We've outperformed all royalty companies over the last 12 to 18 months by a wide margin. Yet, because we have acquired some really fantastic assets, we are still undervalued to our peers. In other words, the net asset value of our properties has increased faster than our stock price. We make a case in this presentation that junior royalty companies are really where you get the most growth in the early years and in that royalty space. And we'll also make a case of how important it is that who your partners are, who are the producing companies that are operating or developing are royalty properties. And because we've been doing this, we've been doing this for about 4 years now with a two-pronged approach. We stake and acquire and consolidate properties, sell them, and retain a royalty. And then we also acquire royalties from third parties and from companies. So because of that, we have generated a lot of properties which have been sold or are in the process of being sold, and it makes us today one of the largest property owners in Nevada. This is the slide that shows our performance compared to all the rest of the royalty universe, at least the precious metals royalty universe. And what we've highlighted there is some of the key transactions that we'll get into later of what's really caused that price appreciation. And despite that appreciation, you can see on this is a very up to date from Refinitiv is the source of the consensus numbers on some of the key metrics that go into valuing royalty companies. The EBITDA, of course, the earnings before interest, taxes, depreciation, and the and also the net asset value. Now, net asset value is very important to look at in the junior royalty companies because you will see EBITDA and cash flow maybe, still a couple of years away. But your net asset value, which is just a discounted valuation of future cash flows, will give you an idea of what a company with development properties is going to look like a few years down the road. So as you can see in the universe here, we're trading at about 0.91 times our net asset value compared to some of our competitors in the junior space. Nomad, a new entrant, but Metalla, who we've been comparing ourselves to for over the last 12 months, and probably our greatest comparison, or best comparison, and they're selling it over 2 times net asset value. Mavericks, another excellent growth company, and what you'll notice is that as far as transactions, if you were looking to the news, is that you'll see that the junior companies down here, Nomad, Metalla, ourselves, Mavericks, these are the companies that are doing a lot of transactions, as opposed to the Franco-Nevada, Wheaton Precious Metals. I think they have not, a great company, but I don't believe they've done a transaction in the last 2 years. So very static, great portfolio, still growing, still expanding, but not through recent transactions. The same with Sandstorm. Just not a lot of recent transactions being done. Those transactions, the transactions today, are getting done down here at the low end with the junior companies. And so we point out that even though we've had great performance in the last 12 to 18 months, up over 500%. But we also point out that 2 of our peers at the other end of the spectrum, who got their start operating primarily in Nevada, Royal Gold and Franco-Nevada, companies that in their first 4 years were up 3,700% and 3,200%. And of course, you can see from the inset that they've gone on and been great long-term performers when you look at the 12 and even over 20-year charts in the case of Royal Gold. So again, this is a function of that the junior companies get a lot in the early years, get a lot more transactions done. There's a lot more leverage as transactions all tend to be more or less significant in those early growth years. Our growth model and what's is similar to the original growth model of Franco-Nevada and Royal Gold, and also sets us apart from most of the other precious metal royalty companies. Only one other one that really has the same model as us, and that is that we're creating royalties, as I said, through staking and acquiring of properties, selling them, and generating royalties. We're also buying royalties from third parties and beginning to do some financings for some projects in the royalty space. So with this model of we've generated a lot of property interest, and most importantly, what this model allows us to do, because we are so successful in generating longer-term exploration and some of our development assets in the well, I lost my I lost my presentation there. Anyway, I'll go on without it. I know it so well, but we do not purchase exploration royalties. We focus on royalties, purchasing royalties that are near-term producing or producing, and that we can put a net asset value that will add net asset value to our portfolio right away. And say don't spend our money on those longer-term exploration assets like some of our peers do. So that's why we have had such good stock performance. First, buying some excellent properties that are going to be in production between now and 2023, 2024, as well as some producing royalties, and don't buy a royalty unless we can see an addition to net asset value right away from that acquisition. Just go over the corporate structure for a minute. We have currently 158 million shares outstanding, 198 fully diluted. We have about 11.5 million of unrestricted cash and $1 million in investments, mostly companies that we have sold properties to and taken stock. And so on an enterprise value basis, fully diluted, we're a little over 200 million today. And the stock's probably right about 200 million. We also have a $6 million line of credit. So we have about $18 million available between our cash and our line of credit for royalty acquisitions without having to go back to the market. Eric Sprott, our largest shareholder and a bit of a benefactor for the company, having provided us with the line of credit, also sold us his Jarrett Canyon royalty earlier this year. On a technical basis, for those of you who follow that, we have a great long-term chart. We've gone through a nice pullback and consolidation here, along with the price of gold and a lot of the other exploration development producers and the gold mining indexes. So I think we're got an excellent long-term chart with increasing volume. The talk about that royalty space just a little bit more, and this is another reason shows you why the junior companies give you such good leverage, and that is not only are we doing more transactions than the bigger companies, and they're more significant on a percentage of our market caps in the junior space, but also the market tends to give you as a royalty company a higher valuation on that NAV, net asset value, and also on cash flow as you get bigger in size. So you actually get leverage there, where as we grow the company, we're increasing that net asset value, and as we grow, we move up this scale and get and the market tends to give us that higher valuation. When We look at our key assets, and the metrics that you want to look at, we believe, in junior companies is really a four-pronged. The business model I've spoken about, where we set ourselves apart by not only purchasing royalties but generating royalties. The management execution, and again, we measure up very well there. Certainly, our peers, companies like Mavericks, the Nomad, and Metala, also doing a lot of transactions. So you really have good management execution across the board in this junior royalty space these days. You want to see, as the company is growing, improving liquidity. Some of these companies are just doing not really worried about the liquidity in the stock as the stock price grows, but more just using that stock to do transactions. We tend to use cash for transactions rather than stock. We'll use cash and warrants. And that the most important thing when you're comparing portfolios of the junior development companies is what we call the path to production. And you want to see a clear path to production, meaning, you can look at the asset. It should have a PEA or feasibility study level, hopefully be permitted or in the permitting process. And you can look and see if that asset really is something that's going to be profitable, but the other aspect that we think is just, if not even more important, is who owns the asset. Is it a junior company that's never built a mine before, never operated a mine, or is it a producing company who knows what they're doing and has the capital? We tend to shy away from these projects that are in the hands of junior companies. When they are that story of moving from exploration and development into production generally does not play out well. We like to see established producers on the other side of our assets. The breakdown of our portfolio is really what we talk about is we define everything is 3 portfolios of assets. Now, those assets might be made up of royalties only, or they might be a leased property that has a royalty attached to it, or they might be a property that we have in our sale portfolio, a property that we have sold. And generally, we'll sell properties either for cash or for payments over a 4-year option plan with escalating payments. And we've got about 25 contracts right now, 26 contracts in that portfolio that are, at some stage of making the option payments. We don't do joint ventures with our property sales. We sell the properties. If they make all the option payments, they get the deed to the property, and we get a royalty deed. If they don't make 100% of the payments, we get the property back 100%. There's no earn-ins. It's a very easy, very scalable model. Provides us with a nice cash flow of over $2 million a year out of that sale portfolio. So consequently, what we've done here is simplified the way we show our assets and just into the key assets, development assets, and exploration assets. Of our key assets, they have 11 of those. 9 are at producing mines. 3 are in production today, and all of them are expected to be in production by 2023. We'll drill into those a little bit here in a minute. The development assets, we currently have 26. Now, the development assets to be in this portfolio, the property has to be at or near a producing mine or a mine that is scheduled for production. Now, if it's in this portfolio, those properties are not in a current mine plan, but the mine is there, and either those those properties are being explored, or they are going to have development work done on them for mining. But the key to them is that these properties don't have to get big enough on their own to substantiate building a mine. The mine, for the most part, is already built, or the property is part of a overall property package of a company that's, say, over 1 million ounces and well on its way to becoming a mine. And in which case we would only have part of the production. But these are all assets that have very high probability of going into production over the next several years. We then have 40 exploration assets. These, like the development assets, are mostly projects that we have generated and sold, and they're either been sold or in that sale portfolio. So they're not royalties or properties that we have gone out and purchased necessarily. But we've got a great package here. 12 of those are currently being drilled. Some of the companies that you may have heard of out there, the BlackRock is operating and purchasing and drilling our Tonopah property. VR Resources, we have a royalty on their whole Big Ten project. And we have several others. With the Contact Gold has our Green Springs project. So some of the best explorers in the space operating in Nevada are working our properties. We also carry a portfolio of properties available for sale. Just as it sounds, we would have these properties available and are seeing probably inquiries just at least 1-2 a week of companies looking for properties in Nevada for purchase and exploration or development. I'll give you an idea here on this slide of just that we just on our counterparties operating in Nevada, we are working with some of the biggest and best operators in the world, as well as some of the best exploration and development companies. We're going to drill down here just now on our 11 key assets. And I'll tell you on the development assets, if you can look at that portfolio in the back of the presentation. I'm not going to really go into that too much more in the exploration, but if you take a look at that and have some questions, there's some very interesting properties in there. But looking at the key assets, Isabella Pearl, operated by Gold Resource, we have a 0.75% gross revenue royalty on that. We also have a 2.5% royalty on all the expansion ground there. Jarrett Canyon, we have 2 resources. This is an old mine, currently now owned by Eric Sprott, 100% privately. We have a per ton royalty on everything that goes through the mill there, and also a 0.5% NSR on the production. So that's one of our, these would cover our 3 current producing assets. At Rawhide, this is another well-established mine in Nevada, operated by a private company, Rawhide Mining, and this is a 15% net profit interest. They've been mining on our claims for about almost a year now, and are working through their development costs to get down to that net profit position. We're looking at that happening here either late this year or the first part of next year, and start to see payments there. At Fenelon, this is one of our Quebec assets. We do have a secondary focus on Canada, and our key asset there is the Fenelon, operated by Wallbridge Mining. We're looking for them to get their small miners permit this year and go into production next year on a small 400 to 500 ton a day basis, to then go in and do some more development work and get the deposit there in the Tabasco and and Cayenne zones more well-defined so that they can ultimately make a mill decision. We think once they do that and build a mill there, it'll probably be more like a 2,000 to 3,000 ton a day operation anyway, and that royalty will have the potential to be paying more like $6 to $8 million a year. At Lincoln Hill, this is a project that is right next to the Rochester mine, which is Coeur's most profitable mine, their largest operating asset. And in the Lincoln Hill sits right next door. It is a defined resource. They're drilling it now for expansion and for mine planning. But they just were approved with to build a new 300 million ton leach pad at Rochester. And the Lincoln Hill ore sits actually closer to the new leach pad than the Rochester ore. And it's 4 times the gold grade, same silver grade, Rochester being known as a silver mine. So that's some ore that they're anxious and are on record as saying they want some to be on that to go on the new leach pad when it's completed in late 2022, early 2023. At Marigold, operated by SSR Mining, our claims are in the current mine plan to start production in 2022. Our Wren property is the extension, underground extension of the Gold Strike mine operated by Nevada Gold Mines. This is the largest gold mine in Nevada. It's produced over 50 million ounces. The Wren property has a couple million ounces that were defined on it. We're going to be releasing a new 43-101 here shortly on that. And they are down to their last million ounces at the underground at Gold Strike at the Banshee mine. And so they're drifting into the property there now with the idea of exploiting that 2 million and also looking to explore that ground from underground. The the other royalty we have there is the 3.5% net profit interest. At Hog Ranch, this is operated by Rex Minerals, an Australian company, currently in the permitting process. And then lastly, Gold Rock with Fiore Exploration. So, and they have just come out with their PEA looking at production in late 2023. So you look at our 11 key assets. As I said before, 9 are at producing mine, 10 are operated by companies that are already mining and operating in the area. It's some of the best operators in Nevada, and actually, probably in the case of SSR and Nevada Gold Mines, best operators in the world. That slide then will drive our revenue. You can see where that net asset value is coming from and kicking in is that we have a very nice slope here, and this is going to continue to grow into 24 and 25 as the Wren property comes on stream and we work through some advanced royalty payments. But the 2 million here is kind of constant. That is what our goal next year is, to keep our G&A covered by this sale revenue. This is out of that coming from that portfolio I talked about that has about 25 properties in it. So that most of our royalty revenue will be going to EBITDA, and starting next year be available to be looking at a dividend program. So management, we do stay we're still pretty thin as far as, operating like a royalty company. Jerry and I do most of the property acquisition together and the property sales and royalty acquisition. Now, we do have a couple of strategic advisors to the board, Jason Jessup and Darren Wagner, that help us in sourcing and evaluating royalty opportunities. So on the gold side, again, this speaks to the management, but execution. and we have achieved all our goals this year. We actually covered all of our goals this year in the first 6 months. So what it looks like we probably will we'll almost double our our goals as far as royalty purchases and property sales. And looking here, we initiated coverage with Noble Associates in March, and we're expecting here very soon to see coverage from a Canadian bank as well. So that's really it on the story. The upside for shareholders now, that junior royalty space, as I talked about, that's where you want to be in the royalty business for the big returns. You just see that higher growth and higher returns, plus you have that accreted leverage as the company grows. The market tends to value it higher. We have a very strong growth model where we are actually generating royalties as well as purchasing them. Again, a key point being that we can save all of our capital for buying, producing, or near-term producing royalties, not having to go out and buy exploration and development royalties. Those we get paid to generate. We have a very clear path to production. 11 key assets that'll be in production, 3 that are producing, the rest that'll be in production by 2023 at producing mines and with the best operators in the world. And of course, then the gold price leverage, where as gold prices rise, our costs don't rise. We just see that increased revenues drop to the bottom line. And also the increased royalty opportunities. This is something this is a competitive business, this royalty business, but it's also an expanding opportunity business in that you have projects that at today's gold prices are being dusted off, things that were maybe not quite economical at $1,400 gold, but now are getting dusted off, going back into permitting, getting new studies done to actually go into construction over the next few years. So with that, I'm going to call Brandon back on here so he can relegate the Q&A. And, I think while he's coming on, I am just going to comment a little bit on these development assets to give you an idea. When you look at this portfolio, like I said, these are all at or near producing mines, and you can see that in the operators here. At Gold Resource around the Isabella Pearl mine, we have 4 properties that will either be satellite mines or satellite deposits for Isabella Pearl. We have 2 at Mount Hamilton, which is a property that Waterton Global owns. We actually sold that to them. It's fully permitted and has a full feasibility study. At Premier Gold at South Arturo, Integra with a War Eagle at Delamar. We've got 4 properties around producing or mines with Nevada Gold Mines, 4 with McEwen, 2 with Coeur besides the Lincoln Hill. So this gives you an idea of when we talk about our development assets, these are real properties near real projects that have a very good chance of coming into production. And then we have the long list, 40 exploration. It's going to have to be 2 slides. I can't even read this anymore, Brandon, on this thing. But again, as I pointed out, 12 of them are currently being drilled, and you can go through this and see that again, there's some very good names in here. So with that, let's go ahead and get it opened up, Brandon, get some questions answered here.
Absolutely. And thank you very much, Trey, for going in such detail. I see that in the comments, I see questions as we're going on as well. So people are paying attention and they're very curious about it. So once again, I always appreciate when executives take their time to be here like you are today. I believe we have about 14 or 15 questions here. We'll do our best to get through as many as we have in the next 21 minutes or so. But the first one is from Steven, and he asks, I believe there was some insider selling. Can you give us some insight on that?
Oh, look, our insider selling has been one of our directors, Bill Sheriff, who sold us his all of his assets in Nevada in 2017, and he did that for some cash, but mostly for warrants. So he has been exercising warrants and selling those. Bill is recently relocated from Texas to Colorado, and he's building a large house there, and just needed he needed to raise the funds. And well, we don't encourage insider selling. I can say it's pretty much come from that one source, and Bill is still very active with the company, and helping us with on the royalty side and everything. He's a big believer, but he's building a big house.
Hey, at one point or another, someone has to sell you. If you have it for years upon years, everyone has put a lot of work into building a company. Sooner or later, even directors yourself, Trey, sooner or later, some people need to be take a little bit off the table there. So I hope that answers your question there, Stephen. Coming up to James, what comes first? Reverse split to get New York Stock Exchange listing, or paying a dividend to enhance share price?
Great question. I mean, I get both questions. I've never had it posed that way. So hats off to Stephen for a great question. Look, here's the deal, as Joe Biden would say. A dividend program is expensive, to administer. And it does take away from a junior company's cash and capital to reinvest. So we always want to consider, in looking at a dividend program, that one, we want it to be meaningful. We don't want to just throw something out there and administer and pay more to the admin people than we pay to the shareholders. We also want to come from solid royalty revenue that's predictable and of course it's something we also want to be looking that it's meaningful when we start it, and that we have the intention of increasing it. With the you have to look at the shareholder base. Today, we feel like, well, everyone would like to get a little dividend. I think if I polled shareholders, they would say, geez, Trey, if you can keep making these kind of acquisitions, just why don't you hold on to my money and put it into new property and into new royalties instead of paying it out as a dividend. And that leads into the second question of who really would want to see the dividend more, and that would be your institutional shareholders. And the importance of a reverse split, which in the junior mining in Canada is almost a nasty word, because you generally see it reverse splits when a company has gone to 2 cents and they can't raise money because the stock exchange says you can't raise it for less than 5 cents. So they're forced to recapitalize the thing and roll the stock back so that they have a 20-cent price. And generally, that goes right back to 2 cents again. But where it really does make sense is to get that U.S. listing. And to get the U.S. listing, we would, attract, in getting the U.S. listing, we would then attract a lot more institutional shareholders. I think the big difference between us and Metalla today, and if you look at us, I'm going to click back really quick to the comparison slide here, and just looking at us versus Metalla with, very close on the net asset value, almost even. We're according to the consensus, we're a little bit ahead of them. They're not, kind of struggling more on cash flow. I haven't, the consensus doesn't show them with a 2021 EBITDA number. But very competitive there, yet they're trading at 2 times their net asset value, and we're trading at less than 1. And the reason is, I think a big reason is their U.S. listing and the fact that they are able to be bought by other funds. So that's a lot of talk to answer that question. So the answer is that we probably would want to get the listing done first. And we are working on the prospectus now and our annual information form. And when you see that happen, the next step would be, then we would be prepared to be able to do the listing. Now, as for those who don't know, the reason you do the reverse split is to get to a price that's well above the $3 minimum, I believe it is, for the Amex listing on the NYSE. And so that's the reason for it, is only to get the stock price. It doesn't really do anything to the NAV or the market capitalization. But to answer Steve's question, I would say that the listing comes first and then the dividend.
Gotcha. Thank you for that. The next question we have here, there's been quite a lot of pressure on the Ely Gold share price. Can you explain what's going on?
Well, I think that first of all, I'll go back to the slide here on on the long-term chart. We had a very nice run. We did a private placement in May. The stock was right around 80 cents. We did the private placement at 80 cents with a $1 warrant. Before we got that transaction closed, the stock had gone over $2. So it had a big run based on us, making some key acquisitions, and then has since been doing, been basically consolidating in a downward direction. But we're back down to our 200-day moving average. The market has kind of been correcting for a lot of the stocks, unless with the exception of some that have had, in the royalty space, where Metla has announced a few very attractive deals here recently. So I think they've had a little bit better performance. But if you look at their chart, when our stock was going from 80 cents to $2, theirs was doing this. They were consolidating between $6 and $8. And so a very similar pattern. I think the other thing that I would mention here is that it was about 3 weeks ago that May private placement came free to trade. So we've had to soak up, and again, those people that did that 80-cent offering got $1 warrant. So it's reasonable to assume that a lot of the people now are taking profits on their stock, or have taken profits on the stock, knowing that they have those $1 warrants backing it up.
Absolutely. And hey, good on them. That's a fantastic investment in that 4 or 6 months or so, whatever that is. The next question here is from Jason. It's a really good question. I'm going to add another question because I know it's very far down. I'm not sure if we'll get through all of them, but one of the questions, this is talking about the increase in gold prices, but really quickly, there's an investor who was asking, the slide you had earlier that showed some of the projections. Do you know roughly what price of gold those projections were based off the top of your head?
Which projections?
I believe you were talking about the forecasting over the next couple of years. Do you know if that was off of $1,500, $1,600, or I know it's coming out of the blue?
Oh, the forecasting for us? Yes. Okay. I'm sorry. Yeah, those were based on 1825 gold.
Gotcha. Beautiful. And the reason why I asked that is because I want to make sure that's a very quick answer, because this next one's a great question. It says, did the increase in gold prices earlier in the year make it harder to make deals that were on acceptable terms? Has the recent pullback in gold helped the process? Is it just me, or has the deal flow slowed down a bit versus earlier this year?
Well, the honest answer to that question is yes. we had two significant deals that we were very close to doing. And when that gold price spiked up, one of them, both of them basically wanted more money. And we didn't do it. One of those consequently went to Nomad for almost twice the price that we had bid before the price of gold went up. And even with the price of increasing gold, and of course this was at 2050 or something like that. And we just felt gold like our stock had made a big run, and we're going to wait for it to come back down. So, when Bank of America started saying gold's going to 3,000, yes, it cleared two deals for us. And now the other one is back at the table. We think we're going to get that one. That we're very close to getting that one put back together. And in the meantime, while we haven't done any big deals, we've been doing some very significant smaller deals. So the deal flow has not slowed down much for us, but it has gotten a little bit more difficult at the higher prices, and with more competitiveness in the royalty space from our peers.
Absolutely. Well, we'll continue here because we do have quite a lot, and we've got roughly about 10 minutes left before our next presentation. This is from Bob, and he's asking, does your NAV calculation include shares only or shares plus warrants and options?
Everything we have, and I just have to be on the slide, that everything that we have is all of our stocks are in the money. So what we use is that fully diluted enterprise value, which means we use all the shares, options, and warrants, less the exercise proceeds, in other words, the money that would come in from those, and add to the treasury to give us a fully diluted market cap, and then subtracting out our cash and investments and adding back in that small amount of debt. So we use it, and you can kind of see here, this slide is done at $1.37. Stock's a little lower than that, so that explains the price to NAV at a little under 1.
Thank you for that. This next question is from Dorian. Why do you feel the large players are not growing royalties? Could it be their view on only purchasing assets at the bottom versus rapidly rising gold price?
The real answer is these guys have a pretty cushy job. They don't have to do anything. Wheat and precious metals. I mean, they're these royalty portfolios. Take ours for example. Now, don't take this the wrong way, everybody out there. But if we did nothing, just stop doing anything, this portfolio is just going to mature and get better and better. I mean, great things are going to happen in our portfolio if we didn't do anything else. For them, it's even more so, right? I mean, they've got the cash flow. They feel that the environment is very competitive. There haven't been a lot of big deals. I mean, if you look at it across the board, not many of the companies, the big companies, have done a lot of things. Sandstorm and Royal Gold just announced a large deal that they did jointly, but there just haven't been a lot available. And again, that's why we think investors really should be focusing at the lower end of the market, because there's just a lot more opportunities for purchasing royalties from third parties, and keep in mind that we would love to go out and buy producing royalties, but even in our space, we've tried to bid on a few. They just, like I said, one of them, I said when the price of gold went up, somebody else paid twice as much as we were willing to pay for it. And it was a producing royalty. We'd have loved to have it, but we we tend to, if we're trading at 1x net asset value, it'd be a dilutive transaction for us to go out and pay 1.5 to 2x net asset value for something just because it's producing. So we feel some of the best value is out the curve a ways. We love these royalties that are 2 to 3 years, maybe 4 years out from production, with solid projects with world-class operators, where we know the projects are going to get developed and be producing. That's where we're finding the best value, and I think that that's that I hope that answers the question.
Yeah, I believe it does. The next one here is from Christian. He writes, from a newcomer here, how much time does it take for such a royalty company to start giving dividends? To piggyback on the last question, to start giving dividends, what are the guidance, or what is the guidance to start giving those dividends?
Well, let's just do some quick back of the envelope. We have 158 million shares outstanding. If we paid a penny a share, that's 1.5 million that we would have to have to allot to a royalty program. And what would that wouldn't even equate to a 1% dividend at our price. So and you probably pay at least $200,000 to $300,000 a year to administer a plan like that. Where a check has to be mailed out every quarter to. We think let's just use that as a minimum amount. We'd want to have a 1.5 million of solid revenue that we could allocate, and that might give us a 0.8% dividend. So I would say that would be a minimum kind of dividend level for the institute. As I said before, we want it to be meaningful, and then we want it to be something we can increase on at least an annual basis, maybe more, as some of these other royalties kick in.
Yeah, absolutely. And I appreciate the answer there. This next question is from Joanne, saying, would you think about going outside of Nevada for royalties, perhaps a global outlook in the future?
I think I'm at a Democratic town hall now, because that seems like a planted question from Joanne. The answer is yes, although we would do it strategically. We are not about. It's difficult we think, for a junior royalty company to just be looking at royalties all over the globe. How you can do that and truly evaluate the assets and everything. So if we do go to another jurisdiction, let's say Latin America, if we were to go to Latin America, we would pick a jurisdiction that we think is the best jurisdiction in Latin America. We already think we're in the 2 best jurisdictions in North America for sure, and probably 2 of the best jurisdictions in the world. So we would want to be in a world-class mining jurisdiction and there's a lot of considerations that go into that. And then we would want to do it with a strategic partner, have a strategic advisors or advisors in that country, and really put a package and then focus on that country for additional royalties. So we don't, in our consideration there, we'd also want to focus on a country where we felt there was going to be a lot of royalty opportunities.
Gotcha. And I'm still fighting laughing on that last comment there. That was a good one, because I'm looking over here, and the next question is from Dorian, and it goes really well with that, saying, how would a Democratic sweep impact the mining and or development of new mines with additional licensing and environmental requirements and potential audits?
Look, why we like the Nevada jurisdiction worldwide is that we think, and this is a great question. I don't want to take it up the whole time because I really could with this and go into somebody else's time. But first of all, we think a Democratic sweep will be very bullish for the price of gold. So for all you Democrats out there, load up on Ely stock. Nevada is run by the Mining Act, and all of the U.S. It's a Congressional Mining Act of 1872. So making changes in that will be difficult. Taxes, changes in the tax regimes and everything in Nevada will take a vote of on the ballot. It can't just be legislated. So we really like that. In Canada, kind of the same thing. Worldwide, I mean, watch out if you have mines in Africa and West Africa and even parts of in Chile or Peru, Mexico. Probably get ready for higher taxes and different ways, and in some cases, maybe even nationalization of assets if things get really tough worldwide, which they certainly could. So, we think we're sitting pretty good in the jurisdictions we're in, and that's why we're in those jurisdictions.
Absolutely. Well, on that question, no, there's a few more here. At the end of this webinar, you'll automatically be put to a survey. It's just going to ask you what were your thoughts on this presentation and things of the like. But there's a part there where it says, would you like to be contacted? If you do have a question that was here and it hasn't been answered, or maybe you have a question you'd still love to be able to hear from Trey, put that in there. Put yes that you'd like to be contacted, and their team will reach out to you, and we'll get that question answered for you. But Trey, I appreciate very much.
Hey, Brandon.
Oh, yes.
If we got just a few minutes, I saw a question pop up from James, and I wanted to get to it because I thought it was a great question. If we got just a couple minutes, I believe James asked about how we set ourselves apart in our property acquisition and our expertise in Nevada. And so I wanted to just point out one that's they've been doing very well with it. It's our Tonopah project that BlackRock has. So here's how that project came together, and we have a dozen that came together the same way in a property consolidation. We've been involved at that Tonopah property since 2017 when we purchased a few unpatented claims. We then staked some unpatented claims. We purchased 2 sets of patented claims from 2 different companies. We then bought in 2 different royalties that were covering parts of or all of those patented claims. Then this spring, we did a transaction to buy in another large block of patented claims to the north, royalty free. And so over that 3 or 4 year series of transactions to consolidate the Tonopah property, we then sold it to BlackRock for $3 million over 4 years and keep a 3% royalty with no buy down. So nobody else is doing that. EMX is our only competitor that really originates royalties, and they do a great job. They do things internationally we certainly couldn't do. That's give you an idea of the expertise, and it speaks to our very extensive database that we have on the properties and the old data on exploration data, mining data, as well as property ownership data.
Beautiful. Well, that turned into a perfect segue, because that's the exact webinar we're going over to right now. If you're speaking of BlackRock Gold, we'll be going over there right now. So appreciate everybody for taking the time. The questions were amazing. We love seeing that. We're going to go over to our next webinar now, where we're going to be able to ask more questions, see from another company. So Trey, once again, thank you very much for your time today.
All right. Thanks, Brandon. Thanks, everybody, for tuning in. Every gold's going higher, we think.
Absolutely. Well, we've got 5 more seconds in this countdown, so we'll say one more goodbye. We'll see you soon. Trey, we'll see you again very soon.